if this happens, then you can jump on the back of it. It is nice if you can get in as soon as possible. I'll show you charts and previous Fed decisions, and they can continue driving the market, as I say, for days, even weeks at a time. So returning to the presentation, I said going back to like the 1970s, especially early 80s, when there's a period of stagflation, you can see federal funds rate right around 20%. So even though people are complaining, specifically Trump, about these latest increases, we are still very low. And what we've had up until that December 2015 hike from the financial crisis till then, what we've had since then is an extraordinary low period of interest rates. So we're still quite low, historically speaking. One of the concerns and one of the arguments for why we should be raising rates now, or why the US should be raising rates, is if something goes sour and the economy turns south, it gives you some wiggle room to reduce and to ease monetary policy again. If you've got interest rates at rock bottom levels, there's not much you can do from a policy perspective. So we're seeing in Japan and the ECB at the minute. So it gives you that sort of buffer and a bit of a cushion if you have higher rates that you can then try and cut in the event of something going untowards. Don't know how to move on to the next slide, to be honest.
Could it be maybe frozen the screen?
I'm not sure. The problem is it's not back connected, so it's showing it here, but I think that's, yeah, like you say, it's the screen from what we had up beforehand, isn't it?
Yeah, but I think it's a function on the remote. You might be able to change.
As you can see, the screen is
business stuff.
Sorry,
We want to have
eyes and spy. Good combination, bro.
we want to have sushi at steaks and sushi.
Sushi samba?
No, never go sushi samba.
Yeah.
It's such an overrated place.
the mouse wasn't working when I was on it.
She's fine. Tomorrow, actually.
Just a quick.
Did you manage to spend them?
Oh, I could.
Yeah,
so what we're actually looking for, basically, as I was saying, is you kind of try to expect what the market's already pricing in, then you look for whether the outcome's more hawkish or more dovish. Now, hawkish means suggestive of higher rates going forward, whereas dovish means suggestive of lower rates. So if we do get something more hawkish than expected, That's seen as good for the US dollar, negative for gold, negative for the T-note. If we get something that's dovish, then it's seen as negative for the US dollar, positive for gold, and positive for T-note. And as you can see with the market reaction so far today, there does seem to be some positioning towards the sort of dovish surprise that we're going to get here, possibly lowering with the dot plots, which I'll come on to later. In terms of stocks, it's not always quite so clear. I think today, if we get something dovish, then it'll be positive for the stocks. But the problem with something dovish is it can sort of undermine confidence in the economy. So if basically Powell says, I'm not going to hike rates today because the economy's so weak it can't really handle it, and that's not good for your confidence in the stock market. So it can be a little bit unsure. And before, when we've seen, in the last couple of years, sometimes we've seen rate increases and we've seen the stock market rally. But I think at the present state where we're at, I think if we do get something dovish, then that would be positive for stocks. So as I watch these events, I look at several markets at the same time. I'll show you how to do like a split screen and have US dollar, gold, T-note and stocks. And what you can see there is how the markets are taking it as particularly hawkish or particularly dovish. Okay, so this is the probabilities from derivatives markets of what you expect from the Fed. You can see these are all the meetings coming up to the end of next year. The main one I want to focus on from this chart is today, obviously. The hike probability is 67.4%, so around 2 in 3 chance that we get an increase. And as you can see, this is split. We're currently between 2 to 2.25%, and there's a 32.6% chance we remain there, 2 in 3 chance that we go higher. You can see there's nothing priced in for a larger increase, and there's obviously nothing priced in for a cut. So if we got something like that, that would be way out of the scope and we'd get a huge market reaction. You can see from this white line, this is historical probabilities that we get a hike, and you can see we're up around 80% back in September and once more in October. That's an 80% probability they were giving to us having a hike today. But you can see we have pulled back lately and fallen down to 60% just last week. That's basically due to poor market reactions, and people are getting less sure that the Fed will go ahead and actually hike rates. So there is a good chance, I think.
Sorry, do you mind for a second?
Yeah, sure.
Apologies about it.
There's quite a good chance, I think, that we could not hike, but still the most likely scenario is that we do. Often when you come into these sort of events, you can see probabilities sort of 95, even 100% I've seen before, which means if the hike happens, because it's already fully discounted, it doesn't have too big an impact on the market. So yeah, like I said, about 2 in 3 chance that we get high. That's quite nice, because if we do get high, there should still be some more positive news. That's a bit of a hawkish signal, so eliminates that 33% of doubt that we didn't get one. And if we don't get a hike, there's enough where it can come out the other way. So either way, we should get some move off the interest rate itself. But I think the bigger move really will be what happens going forward. So I'll talk about the dot plot next. And the dot plot is basically a release in the economic projections from the FOMC, and it's a guide of where each FOMC member thinks the rate will be in the future. So the markets are very sensitive to this, and any changes in this can really move the market. So this dot plot, the economic projections, are released at every other meeting, so the ones with the press conferences. And what people do normally to try and analyse it, because there's so many dots, it's a bit pointless trying to analyse who's each dot and where that means each member thinks the rate's going. So people normally try and take an average, and the one that most people settle on is the median. You can see the median projections are taken from this green line and drawn through here. So you can see this is 2018, so back in September, this is what people were predicting for this year end of 2019, end of 2020, 2021, and then longer term. Longer term's got more interesting, because you can see the median now expect the longer term interest rate to settle around this level, which is 3%. And if you go back to that chart I was showing you of rates back to the 70s and 80s, you can see this is quite a low level to be at in the longer term. The most important thing I think to look for today will be what happens for 2019 expectations. So when the Fed last met and released this in the end of September, the median projection here was for 3.25%, which was basically a hike now in the December meeting and then 3 hikes next year. At that time, the market from the Fed funds rate futures, this blue line, thought that they were being a little bit overly optimistic, and they were just giving 2 rate hikes as a projection for what they think next year. That was as of the meeting in September, when I say stocks were near all-time highs and everything was looking a little bit more rosy. Since then, market expectations have dropped a lot, and you can see we're just expecting 1 rate hike next year, and that's not even fully discounted if you look at the other charts. So market expectations are very low because the market is expecting these dots to be moved lower when they're released later today. If they're not, then you say that's quite a strong hawkish surprise. The market might be a little bit caught off guard, could see a strong move higher in the dollar. Bad news for stocks, and bad news for gold. So what happens here, I think, is one of the key things to look tonight in terms of the dot plots and where these move in terms of their projections going forward. So just summarising, since that September meeting, what's happened? Some of the main markets, the S&P 500 is down a little over 12%, US dollars higher by around 2 to 3%, the T-notes up around 2%, which basically means US 10-year yields have fallen, and gold's up by around 6%. So the big one here really is stocks, and I think because the stock market is seen by so many as a sort of sentiment gauge of the overall economy, the big move in stocks lower that we've seen could really start to impact on Fed thinking. This is what's called a US Surprise Index. So this looks at several releases of US economic data. So it looks at employment, it looks at consumer spending through retail sales, it looks at inflation, it looks at housing indexes, and basically 0 is neutral. So anything above 0 is showing that the data is coming in better than forecast. Anything below 0 showing it's coming in worse than forecast. What you can see is from the start of the year, when we're getting very strong positive surprises consistently, we've pretty persistently fallen down lower, and you can see now we're back in negative territory. If we look at a longer view of this, you can see, very broadly speaking, as you'd expect from a surprise index, it does sort of mean revert to around 0, but extreme readings can stand out, and basically you can see whilst we have fallen down from those high 80s, which was the highest in several years that we got at the start of the year, the market had improved very quickly from these lows that we saw in 2017. So in terms of economic data, we have softened a little bit, but a lot of this came in the earlier part of the year really, and the move higher, stocks made all-time highs in September. That was coming despite this softening in US data. So maybe it was a little bit of a case of the stock market carrying on regardless, and having like a wake-up call and realising it was getting a bit carried away and not really supported by the strong economic data. But I say this isn't particularly bad, but it's back around the average of the last few years rather than getting very good. And we had this huge swing in optimism to real pessimism to real optimism, and this can happen quite regularly in sort of surprise indexes, because when data's coming in very high up here, everyone's upgrading their estimates. Economists' forecasts are always going higher and higher and higher. Non-farm payrolls is consistently over 200,000. The ISM PMIs are over 60. Again, a lot of very good data, but it's kind of unsustainable if you have it short term. And because you've had a short term big pickup, you then extrapolate that higher and think we're going to keep getting better data. So we've fallen back down a little bit, and I think this could also weigh on Fed decision making a little bit later on. Finally, Donald Trump. Trump has obviously been quite a big influence on the markets ever since he won the US election, and he's been an outspoken critic basically of the Federal Reserve, which is very unusual. The Fed is supposed to be impartial, they're supposed to be apolitical, but as we've seen here in the UK with Governor Carney, it's very hard to do that job without getting drawn into the politics behind it, because whenever you say something, it's taken as being politically leaning one way or the other quite often. Trump's gone a lot further than what we've seen Theresa May or even any president in the US really for the last 20-30 years, and actually criticising directly what the Fed are doing in terms of raising rates. Here was a tweet where he was talking about the strength of the US dollar, saying that the Fed's even considering yet another rate hike, and that was about 3 or 4 days ago, and this was just yesterday. I hope the people at the Fed will read the Wall Street Journal before they make yet another mistake. By that he means another increase in interest rates. Don't let the markets become any more illiquid than it already is. Stop with the 50Bs. People aren't exactly sure what this means, but they think it's referring to balance sheet reduction. So you have quantitative easing, where you're essentially buying assets and asset purchase programs. The Fed for the last year or so have been doing the opposite of that. They've been basically trying to roll off their assets on the balance sheet as they let some of these bonds expire and don't repurchase them. And they're currently doing it at a pace of $50 billion a month. And I think that's what he means maybe with he doesn't like to see this quantitative tightening, because in large part a lot of the rally we've seen in stock markets since the last financial crisis has been driven by this ultra loose monetary policy. Feel the market, don't just go by meaningless numbers and then wishes the Fed good luck. It's quite funny. So that's the presentation I was going to run through. Does anyone have any questions related to anything I was talking about? Sorry, it's a little bit disjointed with the technical issues. But if we want now, I'll go to the platform, I'll show you some of the markets, I'll be watching over this, and I'm not sure what time it is, but yeah, it's only 10 to 6, so we've still got plenty of time. So, in terms of these events, you can actually use the traders talk. I'm not sure if we've got the right player on the laptop, but if you do, you get the traders talk, and it's basically someone who reads out the event as it happens. So I'll say straight away at 7 o'clock, Fed increased rates by 0.25%. The median dot plot went to here or here, and it's quite a good way to get very quickly the news as it comes out. But so I'm not sure if it will work on this laptop due to it just said we don't have the Adobe player installed. But it's a very nice way of getting the news and not having to read it, because obviously if you're reading it and changing from page to page, you're not watching the markets as they go. So we'll start with the US dollar index. So I'm just highlighting where we've gone basically in these markets since recent meetings. So there was a Fed meeting at the start of November, but because there wasn't that press conference or anything, I'd say it wasn't really a live meeting. You can see we're back almost exactly where we were then, just above the 96 level. We're going back to this Fed meeting in September, the last one with the press conference and dot plot. We've seen a fairly decent push higher. Currently around 2%, just over 2% higher, and just pulled back from those highs around 97.50. If you look at it longer term, you can see we're actually at a pretty decent level. You can see we came down these lows around February, March time, but since then we've had a real strong push to the upside. We've rallied from around 88.40 up to that 97.50 level. Coincides roughly with these previous highs, and how we trade, I think, or how it reacts to this Fed meeting will very much determine where we go going forward. You can see today and in the last few days we've had a little bit of a sell-off. You can see here today we dropped down to the lowest level in around a month. As I say, I think there's an expectation that we do get something dovish out of the Fed tonight. Now, Euro US dollar is obviously the main component of the dollar index. I think it accounts for 58% of it. So there is obviously quite a decent inverse correlation between these. Obviously in this market, dollar weakness is shown as Euro US dollar rallying. You can see we've pushed up to the upside here. Since that Fed meeting we had back in September, this was one of the strongest markets that carried on reacting to it. So we got positive news. As I said, they increased interest rates. They said there'd be 3 hikes next year. Powell was fairly hawkish in his press conference. We got a big down day, and then you can see it continued for several days. We did pull back a little bit, but then we went lower once more. There is a possible head and shoulders here. You can see shoulders there in the head with this falling neckline, which you could say we've broken to the upside. But I think it's difficult really to try and trade off it here on the long side unless you get a very clear message from the Fed, because you're not far off this resistance around 114.55. If you do break above this head and shoulders, you could take a target as a symmetric move from the neckline to the bottom and project it above. Now give a target around 115.36. That could be an area to look to. Dollar yen is another market which we've seen weakness in lately. You can see last few days we've had sell-off, as I say, we're getting a bit of a pullback in the US dollar. This is an Ichimoku cloud which I've laid over it, which is quite nice to identify longer term trends. You can see we break down here and we continue down for several weeks, even months to the downside. And since we've pushed up back there, we had a nice uptrend, and now we've possibly come back down below. We've not got the confirmation from the other lines, but you can see the market is maybe turning lower. Are you guys all right? Or?
Yes. Sorry.
Pound US dollar is an interesting level. I think those ones I was just running through are possibly well positioned if we get dollar weakness. Could see further upside Euro US dollar, dropping US dollar Japanese yen. If we do get a hawkish surprise and some dollar strength, I think this 127 level here is quite important to keep an eye on. And I think we could easily push back down if we get a strong dollar move here, 124.75. So my preference if I'm trading FX over this, if I'm looking to long the dollar, I think short pound US dollar is one of the nicer ways to play it. If I'm looking to short the US dollar, I'd probably rather be long Euro US dollar or possibly even short dollar yen. One problem with trading dollar yen off the back of this is if you get something dovish, it will probably be seen as negative for the dollar but positive for the stock market, and dollar yen often works as a sort of proxy for the stock market. So if we have stocks rallying but there's broad dollar weakness, then you may see a little bit of indecision in dollar yen itself. It may not be the cleanest dollar move because you get the dollar side pulling it down, but obviously the improved risk sentiment pushing it up. I was mentioning the T-note earlier. This is going back to those two previous meetings, September meeting and the November meeting, and you can see since then, particularly the November meeting, we've had quite a sustained push higher in this, basically as US interest rates have fallen. And this is obviously due to the market expectations I was showing you of less rate hikes going further forward, and you can see in the last month, maybe 25, 30 candles there, we've had quite a nice clean push to the upside. So I wouldn't normally trade this market over the event itself, but it's quite nice to watch as a gauge and kind of see how the bond market at least is taking whatever's coming out of the Fed, and then you can compare that to how the dollar's reacting and also the stock market. Moving on to gold, we actually broke up earlier today. You can see got above 1250, I think reached its highest level in about 5 months, but we are just pulling back a little bit now. If we do get something dovish out of the Fed, I think we could get a real push to the upside here. Could easily go 1265 today, even up possibly towards 1288. On the other hand, if we get something hawkish and we get a rejection here, that's a pretty negative signal, and we could see pullback down into this area. You can see previous Fed decisions. The one in September, we had a decent drop, then the market reversed higher. November, we had a decent move to the downside, but then the market again pulled back. So there wasn't really much follow through in gold to the last 2 Fed meetings. Now this is possibly the most interesting chart I think at the moment to watch over this US 500. If we look at it like this. So you can see just yesterday we bounced down, retested these February lows, 25.29. I think this is now really important support. If we do break out to the downside below that, if we get a negative reaction today, that looks very ugly for stocks, and you can go back on longer time frames to try and look for your next reference point. But for now, whilst those lows remain intact, we've basically had quite a broad range here. I think the uptrend has been certainly called to an end, and it probably ended in earnest here, even though we did slightly go higher back in September. But what you can see is really, for me, looking at that, it's more of a range-bound market, really, rather than a trending one. As I said, we were back up these highs when that last dot plot was released in September, 29.46, the all-time high, but we have pulled back significantly from then. We had recovered before the November meeting, and we're looking quite positive into it, so there wasn't really too much that came out of the Fed that day anyway. It was around US midterms, if anyone remembers following it then, but we have since pulled back again. And I think, like I say, if you go longer term, you can start to look at it from perspective. Lost the mouse. You can basically see anyway, we were in this strong trend higher, and then we've pulled back, and like I say, we've kind of flattened out into a range, I think, rather than a trend anymore. Take that off. You can see we've obviously been rallying strongly in recent years, but this year's been something a little bit different. If you put on the 200-day SMA, you can see a very simple long-term broad brush sort of way to identify the trends. 200-day simple moving average. Simply, if price is above it, we're in an uptrend. You can see after these shocks for Brexit, Trump election, the market nearly all of last year was in a very clean, nice uptrend, well above the 200 SMA, which itself was pointing higher. We did have dips back down to it. This was the February sell-off. This was around April time, but we continued to hold above it. But after we dropped back down in October, rallied around it, we've now well and truly quite far below that 200 SMA, and the SMA itself has sort of leveled off. This doesn't mean we're set for a major downside, but if we do take out this low here, 25.29, there's not really much by the way of swing support to suggest this would stop at 25.10, 24.90, something like that. And if you look at it as a sort of consolidation range pattern and you break out to the downside and you look for the same moves below, you're talking almost 400 points below. So there is quite a bit of scope for downside if we do lose this low of 25.29.
Could I ask you to zoom in on the where they met for the first time at the very top, the very peak? Because there's a particular trend after they meet for the second time, or the last one, where there is a decline, then recovery, and then potential rise, but in this case, another decline.
So you're talking about this part of the chart here, yeah?
Yeah, I just mean like, yeah.
So basically, I think what happened was from the start of October, we did see a change in sentiment in the market. So I said maybe it was coming because we were getting softer economic data for a while, but up until then it was kind of seeing through it and we were pushing higher, making new highs. This day in particular was a big down scary day, which we've not seen anything like for a while, but you can see it did bounce right around that 200 SMA. We hovered around it, but since then you can see rallies above it have really proven to be selling opportunities, and we are possibly going lower. Another way you can look at trends, if you look in a specific time frame, if you can look at higher highs and higher lows if you're in an uptrend, or lower lows and lower highs if you're in a downtrend. You can see from here we made a lower low, lower high, lower low, lower high just. Didn't quite make the lower low, lower high, and now we've made another lower low. So I'd say in the near term the trend has sort of possibly turned lower, but we've still got this last support that I think we're kind of clinging on to at 25.29.
But they were blaming Johnson & Johnson for the market.
You mean recently? Was it Friday, I think?
We did.
Yeah, I mean, there's been lots of stuff. I think there's been cracks under the surface for a while. If you remember back in July, was it, when we had Facebook drop around 20-25% overnight, and that was one of the stars of the market. Amazon's pulled back quite hard. Yeah, you can always blame it on something. If you look at Johnson & Johnson's weight in the index, it's not really big enough to on its own account for that. But you could say that it sours sentiment of other stocks. Apple is a classic bellwether, where people look for Apple, and if Apple's doing poorly, people start to worry and think sentiment's going down. But yeah, Johnson & Johnson's one of the ones lately, which has been bad. And did you see FedEx shares overnight? FedEx yesterday was another one where the market had looked to recover into the close, and got those poor FedEx results.
They reckon whatever they gained on 2018 will be lost.
Yeah, well, we're now negative on the year, I think. You can see. Where are we? So I think we began the year. Yeah, we began the year here, 2678. So we're currently down on the year, not major, 3-4%. But when you consider where we were here at the start of October, there's been quite a marked shift in the last few months. I think this so far has been the worst December since the Great Depression, I think since 1931. December is typically a very good month for stock markets because it's kind of year end, there's not too much shifting around, and markets typically are sort of rallied up into December. If you heard of like the Santa Claus rally and things like this, seasonally it's been very good. But we've had a combination of things. I think the trade concerns with the US and China have come back to the fore. There was that Trump and Xi meeting at the G20 in Buenos Aires where people tried to jump on the back of it and thought, oh, we're having a breakthrough, then realised there wasn't actually much that materialised from it. We've had consistently increasing interest rates. I don't think they're a large contributor to this sell-off, but they have possibly played a part.
Oil?
We've had oil. There's been a massive drop in oil. Oil's dropped 35% in the last 2 months. Obviously that means any energy stock, ExxonMobil, companies like that, BP are getting hammered. There's been several stuff. There's more. So if you go back to 2016, we had quite a strong rally on the back of Trump winning the election. After the midterms, they obviously lost the House to the Democrats. This means there's less likely to be sort of short-term pro-business ideas pushed through, like tax cuts, large infrastructure spending. It also means the chance of Trump possibly being impeached has increased. I still think that's unlikely, but it's more likely than if they control both houses. And like you say, there's just been a general sort of levelling off in earnings and results. But we're coming on the back of a very good few years. And for all the doom and gloom, if you watch CNBC or Bloomberg or something like that, we are only down 3 or 4% year to date. If you look at the German DAX, the FTSE, Euro stocks, it's a lot worse declines. China's been in a bear market now for 6 months, I think, 7 months. So the US is still holding up relatively well, but compared to where we were when the Fed had their last live meeting in September, we're a lot worse off, I think, from a stock market perspective. This is the US 100, so this is the NASDAQ, if anyone follows this, more weighted towards tech stocks. It's a similar story. Obviously, you'd expect most of the indexes do look fairly similar. But this has been quite nice because it's kind of traded a little bit more cleanly, I think, in the big picture than the S&P 500. I've got the 8 period and the 21 period EMAs on here. If you have the 8 above the 21, that's indicative of an uptrend. You can see nearly all the way higher. We had a little false bear cross here, but mainly it's been on the upside. But ever since we had this negative cross there, we've been in the downtrend. We did threaten to come back above this gap higher, was after that Trump-Xi meeting when people were thinking there's a big breakthrough here, and then people realised they hadn't actually agreed upon much. But you can see how quickly this gap was filled and also how aggressively this gap was filled. Down, and this huge big down day. Try to recover, another big down day. And you can see it's not the most scientific way of looking at markets, but just from your naked eye, you can see quite clearly the bigger days have been the selling days. And it's the same if you look at the volume in the market. The bigger days are the down days, which is telling you that the market is a little bit concerned. And we're getting false rallies more. You can see last week, I remember we had 3 days in a row. We were trading up nicely in the morning every day. When the US came in the afternoon, turned back down lower and then back on the lows. You can see rally, rejected, rally, rejected, rally, rejected. All around this 21 and 8 EMA, we're moving back down lower. Today we've got back up to that 8 EMA, but nearly whichever way you look at it, the markets are in a near to mid-term downtrend. But we have had a bounce today, I think, because people are hoping that the Fed will possibly hold off on hiking, or if they do, they'll do it in a very gentle way and they'll try and reassure the markets, calm the markets going forward. The last chart to talk about is the US 30. Like I say again, it's a similar picture. What I wanted to just talk about with this one is how you can use Fibonacci retracements, particularly after big moves. So if we have found a bottom here after these recent declines at 23,460, if this holds, you can take fibs from the highs to the lows and you can look for pushes back to the upside. What's nice about when you've had such a big move like this is it wouldn't take a huge retracement to have a decent rally higher. For instance, the 23.6 here at 24,283 is almost 400 points above the current market. If we get back up to the 38.2, which is obviously not even half of the decline, it's not far off 1,000 points, just shy of 900 points. So it wouldn't have to have a huge turn, and it's not like we need to get back to all-time highs to have a decent rally. There's plenty of scope to make money in there. On the other side, you can use Fibonacci retracements as possible short entries. So if you flipped bearish on the market and you think this market's going lower, sell the rally sort of mode, you can say, okay, I don't want to sell the low because we will get some sort of retracements. Markets don't go in straight lines, you get some noise in there. If you do pull back up to this 23.6, you can then be looking for some sort of rejection, some sort of sell signal.
I think also it's above 200 SMA line, I think.
The US 30?
I think. I'm not really sure if
I don't think it is. I'm pretty sure they all fell below it, but we can check. Just looking at it, it doesn't look like it would be, because that's about 200 candles. Yeah. It's similar to the US 500, you see. We break down and we found a bit of support, and a lot of people are saying it's a pullback to 200 SMA because some people like to trade off that in an uptrend. If it pulls back, that's a nice dip to buy. But you can see we're quite a long way below it. We're 1,200 points, and also it's leveled off, which isn't a sign of an uptrend.
So if we go back, we might just see all the way to 25,500, I guess, roughly. Before
if it retraces 50%, it'd go to 25,200. But like I said, I think the danger is, same as for the US 500, if we lose these lows, then there's very little by the way of support. And you're looking at this whole rally. This is the US election when Trump won. And if you remember, if you were trading over it, the initial reaction was very negative in the stock market. Futures would limit down. Which is basically what happens when the market drops 5% outside of US cash hours, to try and stop the market crashing. But by the time they opened in the afternoon, they were only down about 2%. By the end of the day, they'd actually closed in the green, as everyone went from this kind of sheer panic that Trump had won to the realisation that he'd be very pro-business and push for a lot of reforms that would basically be good, and roll back regulations for banks, for instance. So you can see here, this is a nice example of a pull into the 200 SMA, bullish action, and then you can see for a year we rallied higher. Didn't even quite drop to it during that sharp drop in February. But I think this was a bit of a turning point because all last year, as I was saying, we had very low volatility. It was a slow, steady grind higher. It was kind of a buy and hold market, an investor's market. This since has been very much more a trader's market, where if you hold a position too long, you probably end up giving back some of your profits. If you sit in anything really, it would have been difficult to trade, unless I suppose you were short here, but we did just about take out the previous highs. So again, if you do drop below 23,457, I've got the low there. 23,110 is the sort of last bastion of support. You can see from here, But if we drop below there, some technical analysts would look for a symmetrical move to the downside, which is 380, something like that. 3,080, so 3,800. I'll get there eventually. 3,800, which would put you back sub 20,000, and it actually works out not far from the highs if you calculate it exactly from where we saw ahead of the US election. So there's quite a lot going on, and I think it's nice when you have these markets at these sort of levels going into these events, because from here I'd quite happily, if we get something very positive for stock markets, I think there's a lot of potential for a run higher, 5, 6, 7%, retrace possibly back to 50%, something like that. But if we do get a negative turn and we take out those lows, then it's a nice short opportunity. So don't want to overbill it, but hopefully either way we should get some nice movement here. As I was saying, I think when you're asking earlier how you trade around these events, you can try and second guess it and take a position beforehand, but you either need a wide stop or quite deep pockets normally, because it can move quite quickly. For instance, if you thought a Trump election victory would be great for the US stock market and you long stocks in anticipation of that, you'd have been right eventually, but there's a high chance you'd have been stopped out on that initial sell-off lower. So while speed is always the aim of the game, you're not going to be so quick either that you can get in on it normally ahead of a lot of algorithms and high frequency trading. So I think the best way, as I said, at 7 o'clock there's several pieces of data release. There's the interest rate and the dot plot specifically are important, but there's also a statement where they basically outline the committee's view on interest rates. Try and take all those into account and then look for the press conference half an hour later. Now, in terms of when you're actually watching over this, how I set my screen up is to use shorter time frames. Obviously, daily charts are nice to look at, but you can get swift short-term moves. So I'll just look for sort of reference points. Daily low here is an interesting point to watch for the dollar. If you get something you believe is dovish coming out, you'd expect that low to be taken out to the downside. And then where are we looking possibly? You don't want to be too specific with levels. You just want to get a sort of broad appreciation for it, because you can have previous support or resistance levels which work really well and then they're just totally blown out of the water if something unexpected happens. So I'll set this one up a bit like that, and then if you just go through it, keeping in mind those sort of big picture things I was talking about. 114.55 I think is an important level. That was previous highs from the daily here, so I'll keep that up on Euro US dollar, and we'll also go stay like this. Let's do M5 actually. Dollar yen, I think this is possibly one of the key areas that we're at, this 112.17. So I think if we see dollar weakness here, but as I said, the dollar yen, it can be mixed because it's also seen as a sort of gauge of risk sentiment with the stock market. So if we get dollar weakness and a strong push higher in stocks, you may get conflicting messages. Just take the cloud off for now. Pound US dollar 127 is a key area to watch. Like I say, I think this might be one of the nicest setups if we do get dollar strength in a short position here. You'll see hopefully in a minute this will become apparent whilst I'm going through these painstakingly and try and set it up. So this is a T-note, as I say, it's not normally the best to trade off it, but it can be used as a nice guide and then a sort of further indication as whether it's hawkish or dovish what we've got out. You can see gold now is pulling back a little bit, and the people who are confidently buying it earlier probably feeling a bit jittery. Gold is often the biggest moving market, it's the most volatile, so we can get huge swings on that. I think if we take out these highs on gold, we get a real dovish surprise, 12.58. This could be a nice one to jump in long. But if we don't, and particularly if we take out these lows here, I think we could reverse lower. US 500, like I say, it's set for a nice day's gains, but a lot can happen around the Fed. And stocks are clearly looking to get some support from the Fed, and if they don't, I think things could get quite ugly for them. So stocks could be very volatile on the back of this. Again, similar to gold, the way I'd look at it, daily highs is your nice reference point, 25.80. We can take that out to the upside in a clean dovish move, then it could be good. 25.29, it's not on the screen because it's a bit far away, but we'll keep that in mind if we drop lower. And then we've got US 100. So when you followed Fed decisions before, what markets did you trade off it?
Me personally, US30 and gold. I think we did it together. Like I always trade before Fed. Like US30, I just go in when it was around 25,570. So we were almost like 350 pips up. But my target is around 25,100. So if I see any negative, I might just do a short quickly on that.
Yeah, it's where we trading at the minute, 23,800. So hopefully this will come apparent while doing it. When I go to the grid system, you can see all the charts at once if you set them up. There's a little bit of a pullback you can see in just the last half an hour. As people are obviously a bit unsure what's going on heading into the event itself. 24,000.
That's a candle. The last one. What quantity you bought? You bought 23?
I bought 23 570.
So you're still a little bit low. So even this one, you're still either just about even or maybe a very, very, very flat.
Even on that level, I'll be still.
So yeah, I have it set up like this on 5 minutes or M15 charts. And what you're basically looking for overall is how the market's taking this. Is it more dovish than expected or more hawkish? Yeah, so 7 o'clock it will come out. Unfortunately, I don't think we've got the score working properly on here. Have you got the platform up on your laptop?
Yeah.
Would it be okay to see if we can get it in there? It's just quite good if you can get it out instantly rather than have to go on the Fed website.
Well, I think it hasn't changed at all. Would it affect?
Yeah. So if they don't change the rates today,
Yes.
I think we'd see quite a big shock in the markets. I think we'd see
Shock going to
I think we'd see the dollar drop.
the dollar.
Yeah, I think because they're expecting it, I think we'd see quite a strong rally in stocks, strong rally in gold. I think the market's given a 1 in 3 chance that we don't get any move, and I think maybe even a greater chance than that. There's a lot of pressure on the Fed at the minute. Trump's obviously leaning on them very hard. And I suppose if you think of it, sometimes they've already hiked 3 times this year. If they're only intending to maybe increase once more next year, they could always pass on this one if the economy recovers and does okay with the markets calm down a little bit, then possibly put in a hike in March and then see how it is further down behind.
So wouldn't they just leave it so that the stocks goes high?
Well, they might. That's what Trump wants them to do. But another big consideration as well is, so the Fed really, they've got a dual mandate. So the two things they're tasked with doing is promoting full employment and also controlling prices. So they're not supposed to be responsible for the markets, but they obviously look at the markets as a reflection of how they're promoting confidence in the economy. Inflation is around their 2% target, but it has dropped lower, and oil is a big component of inflation. As I said earlier, we've had 35% drop in oil in the last couple of months. What this means in all likelihood is we're going to get low inflation going forward, which is good news for the Fed, because it means that they're not in that position where they need to increase rates. If you remember, about a year ago, here in England, the Bank of England was in that awkward position where the economy wasn't doing great, but inflation was above 3%. They're supposed to keep inflation below 2%. They didn't want to hike rates. They were reluctant. They passed on a couple of opportunities, but eventually they had to kind of cave in and hike rates because they said we can't justify letting CPI run at 3.1% when we're supposed to keep it at 2%. So there's lots at play that goes into their decision making purely by their mandate. It's just maximise employment. So the unemployment rate in the US, lowest level in 30 years. Everyone knows the labour market's superb there. And if inflation's not running above 2%, and they expect it to drop in the future because of what has happened with oil, you have what's called like a pass-through effect. So just because oil drops, inflation doesn't drop straight away. It takes time to trickle through. They've got plenty of scope really, if they like, to hold off because of these things. So it wouldn't surprise me if they don't hike today. And I think if we did get that, that would probably be the biggest market move. And I'd say it'd be bad for the US dollar.
So they couldn't connect it.
Alright. We might be able to get it. The only thing is it should really be.
Like for the long term, you're going to go 100%.
I haven't looked at it as well.
Remember, like, we did the same track in the first time.
Yeah, we I remember talking about, but I haven't looked at it.
Yeah, that's when you like for 12,000. So 12,000 around 12,000, so that's around 50 something. Difficult, that's a lot.
Does anyone have any more questions around this one?
Gold was up 6%?
Since the end of September. Hold on, I can show you on a different chart.
What's it?
Especially like from last month, it just gone from 12,000 something to just like.
Yeah, it's up.
It's
A lot of the gains come in the past month, really.
Yeah, almost by 2%. Like
Yeah.
1.5%.
So it hit its 5-month high earlier today.
That's very good.
So this is what I normally view, but with 12 screens it's a little bit difficult.
Yeah.
And obviously some of these aren't as specific to the US, so I try and do more US centric. The US dollar CAD could be quite a nice one as well actually, but I can fit it on. You can see here, end of September was around here, I think. I think it was here actually, the last Fed meeting. We had this really strong push here and I thought it might really take off because this was when stocks sold hard. So in general terms you get sort of risk on, risk off sentiment, and if you're seeing a lot of fear in the market, a lot of panic, you normally see stock markets dropping and people seek out safe havens. So see gold rise, see Japanese yen rise, see the Swiss franc rise, see the T-note rise. And I thought, because this was a big down day in stocks, this might really take off for gold, but it's been a little bit meandering really and not gone too far. But since here, the last month, we are starting to push higher. And I think if we do get a dovish shock, there's a lot of scope for further gains in this. So if you look at it on a weekly maybe. So obviously it's hard to trade off these sort of time frames unless you're looking to hold for long term. But
When you say long term, do you mean weeks?
No, I suppose if you're trading off a weekly time frame, you'd normally expect to be at least, you know, something like 10 to 20 candles, which would be 10 to 20 weeks. You can see not that long ago we were 1365, and if you go back even further, you can see. If you're trading with us on CFDs, the contracts last for 365 days and it expires. You can just open a new contract then if you like. But normally, people trading over longer time horizons like that don't trade so much with leverage. It's normally straight buying, or, you know, for gold it'd be like an ETF or something, because you have holding costs and things like that against it. And if you're trading with leverage, you can't allow as wide a scope for, you know, pullbacks against you and things like that.
Yeah, but I think stock is like, you know, the stock you can hold and it will be free on that. It's just called points with overnight charges and stuff like that.
Yeah, I think certainly short trading, short term, leverage is a good tool if used correctly. The overnight financing costs aren't normally a big portion of what you're making or losing in the market if you're trading actively. But if you're looking to buy and hold, you know, 5 years out, then it will eat away at you if you do hold, you know, that sort of leverage position. And the bigger problem really is not so much the holding cost, but if you're leveraged long US stocks 5 to 1 and they drop 20%, that's 100% decline for you. So you don't have that ability to ride through downside the same on a long-term perspective. If you trade with leverage, I think it's quite important to be pretty strict with your stop loss, because you don't want something to go a long way against you because it's multiplied by the leverage. The same way, if something goes for you, it's obviously multiplied by the leverage as well. But yeah, long-term investors don't normally use leverage. You know, your Warren Buffetts and people like that say they'd happily buy stocks if it drops 30%. They're not having to worry about it. If you're leveraged up, something drops 30%, you start to get a lot more concerned. So yeah, this is the way we'll look at it. So there's a US dollar across the top, and here commodities, T-net and gold. Then we've got stocks all along the bottom, US 500, US 100, US 30. And I'll see if we can get it so that it says the news out loud through the transport. If not, then we may have to try and I've used Twitter. Twitter's a very good source of information very quickly. If you follow the right people, you can get news out in a matter of seconds. And also, so when the announcement comes, the Fed release a statement and they release their economic projections, 2 separate documents on their website. So you can go on the website and scroll through, but then you need to find the document, get it uploaded, scroll through, and it can take 30 seconds or a minute, which is quite a long time compared to news agencies which say it straight away. Is there any more questions on anything? Should we have a quick show of hands? Who thinks the Fed will raise tonight? So the market's saying there's a 67% chance that we get an increase from the Fed. No one?
All the indications are that the market's going to go.
I think they're in a difficult position, the Fed, because if they do change their path too much, it's kind of showing weakness, if you know what I mean. It's showing they don't have faith in the economy. I was speaking to my boss just earlier and he said, how positive do you think it's for stocks if they don't cut, or if they're very dovish with this? I say short term, I think it definitely is. I think, you know, today, tomorrow, maybe even next week when the market's open. But longer term, it's not great. And he said, yeah, I remember that in the financial crisis when the Bank of England were expected to cut by 25 basis points in 2008, and they cut by 50, so they did a surprise larger cut, which you would think, from the idea that lower rates and more dovish is good for the stock market, is supportive. But people thought, oh, if the Bank of England think it needs a 50 basis point cut, the economy's in real trouble here. This is really bad news for the stock market. So it can send that signal. It's why stocks, they have that sort of dual aspect pushing on them around these sort of events where you're not sure if it's good news or bad news, really.
But they don't have enough time until the end of the year.
What enough time to what? Sir?
For the there's the holidays and all that.
Yeah, you mean to rally
Yeah.
significantly? Yeah, I mean possibly. One thing that people often say, so have you heard of the Santa Claus rally? Santa Claus rally, people mistakenly really say it happens around December, but it's normally the period between Christmas and New Year. And the idea is you buy stocks.
Yeah, that's quite short, just a week.
Yeah, but it's the best average weekly return, I think, of the last 50 years. It's up about 1.6, 1.7%.
People have the assumptions in Taiwan.
Sorry?
And people have
Yeah,
assumptions
well,
in
people
Taiwan.
think Santa's coming, so you buy it, and news agencies always roll it out. But it's supposed to be during that period, and the idea is basically nothing's happening in that period, so it's very unlikely you get negative news for the market. And there's another saying that you can say markets are thin to win. When it's light volume, you don't normally get a decent decline because no one's really selling the market. If you were going to sell, you'd have sold hard before Christmas and then probably left it. So you can get quite just slow, steady grinds higher. If you watch it on short time frames, when we've had it in the last couple of years, you see sort of like 10 and 15 candles in a row where it's just going slightly higher, slightly higher. So it's not a face-ripping rally, but over the course of a few days, you look at it and it's 1.7% is not a huge move by any means in the stock market, but there is a tendency in that period for stocks to rise. But perhaps most tellingly, I think, I don't know the exact figure, but it's like 6 or 7 times in the last 50 years it's not risen.
But they
Then
didn't
it's
have,
been very bad next
they
year
didn't
for
have
the stock
Trump
market.
before.
Well, yeah. You never know. He's changed it a bit because politics has become a lot bigger force in the markets, I think, in recent years because of Trump. Obviously Brexit's
Trump
having a big
factor.
impact as well, yeah. And it used to be a lot more driven really by central banks, economic data, these sort of things. These are obviously still important, but I think politics is playing a big role because there's big political shifts going on, and someone like Trump can do something which is very positive for the market or very negative for the market. I was chatting to another mate who's a trader the other day, and we were saying, do you think if Powell hikes today, he could get fired? And then how would the market react to that? And I said, well, that's a good question, because would the stock market think Powell's going out, so Trump will get in someone really dovish, and he'll just keep rates low from there? Long term, we'll have big problems with inflation, we'll probably have a bigger bubble that bursts, but for Trump's tenure, he could easily keep this going for another year or two, up until his next election, possibly.
What about the housing market? Because there's a lot of negative things.
Yeah, so housing market, that's one of, in the surprise index, not the most recent release, but the one before, I think was very negative for the US. It was caught a lot of people off guard. Interest rates obviously play into the housing market because a lot of houses are mortgaged, and the higher rates, the more expensive it is. People are getting, because if you think, that chart I showed you of Fed fund rate over the last 30 years, anyone who's bought a house in the last 10 years is used to base rate plus 1 or 2% margin or whatever, but you're used to a mortgage of 2 or 3% on it, so you can be very highly leveraged on your house, but it's not a very expensive monthly outgoing. But if you're back in the early 90s, where base rate in England was 18%, your mortgage all of a sudden, if it's variable, or if it's fixed and expires, it's going to be 20%, which is huge interest on it if you look at the US in the 80s. So housing market is somewhere people look to. I don't think the housing market's really a problem. I don't think we're anywhere near as bad as it was in 2006, 2007, 2008, where you're getting the sort of ninja mortgages and you were getting huge rapid house prices rising very quickly. Subprimes, yeah. I mean, you were getting loads of people. Have you seen the film The Big Short? That sort of story and everything around it, and the way that banks were rolling it out and people were buying houses and taking equity out and buying another house on that equity and buying another, and getting very highly leveraged. I don't think we're anywhere near as bad as that, but it is starting to weigh on the housing market a little bit. UK house prices, I think, have levelled off pretty much. You're seeing some declines. US in general has still been ticking higher, but their interest rates now could be going up to 2.5% today. It's not high by historical standards, but if you're a mortgage owner, or a homeowner with a mortgage, I should say, you could easily be paying 4.5%, 5% on that now, whereas 4 years ago you were paying 1.5%, which is quite a big difference on an individual level. It's something to watch, but another thing really financial crises rarely repeat in exactly the same thing, because the last financial crisis was that. Some lessons obviously aren't learned by the fact that there is ongoing financial crisis, but you rarely get the exact same cause causing the next one, if you know what I mean. There's some talk at the minute, if you're looking for sort of doom mongering in the US, about high yield bonds. So high yield bonds obviously are risky loans, and these are pegged loosely to the base rate, and as the base rate, when the base rate was very low, so 0.25% for years, people were having to take on more risky loans to try and get some return on their capital. So they were, rather than just offering high quality loans to people with very good credit ratings, or very good credit ratings, there was a lot more sort of getting towards a junk level bonds and loans issued. And now there's an idea that as the Fed are hiking rates, it's starting to get more expensive, especially if you have margin priced on top of these. If you start to see loans default, the whole financial system comes in trouble, because that's essentially what happened in the last financial crisis. Loans defaulting, and then not only do they lose, but the person who lent them that money lost, and the person who insured that loan loses, and it can have a trickle-on effect. So there's some talk, I don't know if you know Paul Tudor Jones, he's like a billionaire hedge fund manager. He was on Bloomberg the other day, and he was talking about his fears about high yield bonds, and default rates on that have risen.
But there is no chance of repeating the same thing.
Oh, there is a chance. I just don't think it will happen. But whilst I say the economic data's turned down, it's still at a pretty high base. We're not getting better than expected data so much anymore, but we're not getting terrible data. And I think what could happen is we've had the stock market leading the real economy. The real economy is catching up when the stock market pulls back, is what people kind of hope from a levelling off. Not all recessions or not all downturns in the economy see massive financial crashes in the stock market. 2008 was one of the biggest in living memory. We've had, obviously, 87 was a big crash in the US, but 2000 there was a mild recession there, and it didn't. You saw the Nasdaq pull back very sharply, but it rallied so quickly before, it was kind of just a bubble bursting. And yeah, there was a drop, I think, in the early 90s, but it was relatively small, and it had recovered pretty quickly. I'm just going to go and try and get Eric, see if we can sort out this news. So if anyone wants to go to the toilet or anything, it's 15 minutes to the Fed decision, and then we can watch it live.
You see how the call and
Yeah, I noticed. I wanted to point it out.
At the same time, US 30 is like up. So technically, if I take more out, we're still going around profit around 300, almost 368. It's almost 400 pips. Not
20 pips?
No, 380 pips. If I take a right hand.
What is the difference between what's happening?
So US 30 is like top 30 tech companies in the US. US 100 is 100 top tech companies.
So, does the 100 include the 30?
Kind of. So let's say the top 10 sometimes are below
Upper.
Yeah. So
That's the
so it's like 130.
Once,
So
but
it's
it's
always
discount.
It's
Like,
30
which
plus
was
the
this
yeah.
Small.
I can't find any.
But we have a really big impact to the thing. This does also come with, but it's not really a lot. Really have a big impact to the housing.
Another one to
So now see, like in 15 minutes, market reaction. Last time I bought it in a long time.
That is a great idea. Oh, sweet. Remember, still use what?
Hopefully we can get this on here.
terms of the statement, FOMC is expected to decline rate hikes. Its current guidance states that it expects that further gradual increases in its target range for the Fed funds rate, which we expect base rates further to be removed. Safety approach to rate hikes. Although we will contribute to the financial decisions.
So that was a live meeting.
So that's just a preview. He's just running through what's kind of expected. And then at 7 o'clock you hear them say Fed hike by 25 basis points. The dot plots are moved in and running through it. We should look at some more up as well.
But the market I see it closed.
Yeah, stock market, yeah.
So how little the outcome?
So you can often get quite big gaps if you look. So the cash market's closed, but the futures are still trading. So if you see here, see the UK 100.
Yeah.
This is still trading, so it will basically mirror what happens to US stocks. Maybe not quite as sensitive, but if we see US stocks rally, and you see FTSE futures rally, and then in the morning, they're like
As an individual, how you'll be able to form your broker?
you can't trade in UK stocks either.
So you have to wait until tomorrow.
You have to wait, so they'll all have closed at 4:30 today,
Exactly.
and 8 AM they'll open.
And
So
by then,
yeah, it can be quite risky, I suppose, if you have.
unless you're dealing with the American,
Yeah, there's not
500.
what you can do if you've got a portfolio of stocks is try and calculate sensitivity to.
Because I always thought about that, this time gap, and they will have more advantage because they can act.
Well, yeah, but for instance, the US elections, we saw huge moves in that. The Brexit referendum happened overnight,
Sure.
news broke, so I think the FTSE opened 8%, 9% lower. So you always have that sort of risk if you hold individual stocks, but normally if you're long-term investing, as I was saying to the guys at the front, you're not doing so much on leverage. If a 10% drop happens, it's bad, but a 10% drop is just a 10% drop, it's not multiplied 5, 10 times or whatever. If you're really worried and something big happens, you can try and hedge it with futures. So what you could do is say, for instance, say now we see something really negative happen for stocks, US markets drop 3-4%, you could short FTSE futures, because then you'd make money there for when the actual cash market opens in the morning lower. But it's not an exact science, you need to figure out how much you short.
There was another person who was explaining about called stock like sarcastic, I don't know. Is it stochastic?
Stochastic?
Yeah. Is that very reliable?
All technical indicators work to an extent.
That one is like hit and run. If you just make anything here,
stochastic,
and then one of them.
Yeah, I'll try and show you an example. So if we just go, we can do it on the FTSE if you like. And then go here. So a stochastic's what you call an oscillator. So it basically is supposed to show overbought, oversold conditions. So you can get a stochastic oscillator. You can configure it to your own preferred settings, but these are the default ones. And the rough idea is when it's below 20 here, it's a buy signal. If you get a positive cross, here's a sell signal. So you can see here it would have worked quite well, here it would have worked right to sell. The problem often with it is because it's on candle closes, it always looks better with hindsight than if you're trading it in real time.
Yeah, I tried it. You cannot.
So like here is quite a strong sell signal, and we're above it. It's what you call a lagging indicator.
So why are they using it?
Some people like it. There's not really like a right or a wrong way to trade it. I think. Something.
No, but this is just pure luck. Pure luck. I can't see.
How it's calculated is it's calculated from price. So these are basically, I think, moving averages of previous price.
Yes.
And then there's this 0 or the 50 sort of central mark, and then you're looking for basically a deviation away from that, then a short-term moving average to turn below a longer
Because
term.
if you look at almost in the middle, is above the 20%, but if you look up there, it's the highest on the top.
Yeah, like I say, I've never found a technical indicator that works all the time. The idea is it kind of aids you and it helps you, but I use it in conjunction with other things.
So you have two screens. You follow up this one.
Primarily, you always look for sort of support and resistance areas. Say for instance, when you found this support here and support here, when you get the positive cross there, it's a little bit nicer area to buy, and you've got a clearer way where you can define your risk and place your stop loss. The problem with these as well is it doesn't tell you where to have your stop loss if you're wrong. And before you know it, you can see a positive cross, then it drops 40 points.
I tried it.
Yeah, by the time the candle's closed, it's not a positive cross.
It didn't work.
I don't personally use it to trade. I don't think it adds much value for me, but like I say, it's not to say it's wrong.
But if you take it on the average, it's still it's not right, even with the average.
Like I say, and it's always lagging. It's always telling you what's happened before, rather than projecting what can happen in the future. And this is why hopefully stuff like this Fed is a good event, because technical analysis is all well and good, but all it takes is someone big to go in the market and do something, and it will totally change the structure of the market. If you trade off the back of something like this and you're on the right side of it, you can have very nice clean moves.
I've got one question. I just look, few charts and then do trading.
Sure, yeah.
But I didn't look the news and then other things. I found myself, markets doing two-way all the time.
Mm-hmm.
If, for example, if I do whatever trading, if I see it's some of the about 50% market, if it's going down, and then 50% markets going up, but not. I mean, whatever happens. For example, if you look at the US 500,
yeah.
US 100, and then US 30, they're doing the same thing. A little bit going up.
Yeah, I mean possibly, but
whatever it's going up, and then you see that USD
dollar index
is going a little bit down. So it's always I can see 50% of markets going down, and then as it's going down, the other act going a little bit up.
Yeah, I'd say just be quick because it's done, but it's not 50% of the time. It may seem like that, but if you actually measure it, for instance, US stocks last year were up, I think, 85% of the days. So it's more complicated than just having up and down. You don't get markets which just go in straight lines, so there will be pullbacks. But the idea is if it's in an uptrend, you can buy the pullback and then push it higher. So downtrend, you can sell the pullback higher. But we can come back to that if we just So like I say, more dovish, look for dollar weakness, positive for stocks, positive for gold. So stocks.
Stock?
High of 25 basis points as expected. Looking at the Fed rate projection.
So high, this doesn't.
Season 2019 at 2.875%.
10 points.
3.125%. 2020 at 3.125%. That's cut from 3.375%. 2021.
Looks a bit hawkish maybe. See what I mean about trying to guess it beforehand? See dollar, see the stocks.
So they narrowed the trajectory here. Median forecast Fed post mix now looks for 2 hikes in 2019 and 1 in 2020. compared to slightly lower economic growth and inflation in 2019 versus those September projections there.
See now stocks are down 30 points in 2 minutes, which is
Fed changing its language as well. Now says expect some further gradual rate hikes. In Fed funds rates will be consistent. So tweaks its language to more dovish there on inflation. Says inflation near target with expectations of little challenge. Most of the economy will quote roughly balanced. That's unchanged. But it does add it will continue to monitor global economic and financial conditions for their effect on the economic outlook. And the IOPR 2.4%, that widens the spread to 10 basis points per the top of the Fed funds target range. It was a unanimous decision.
So it's not that big a move in the dollar yet, but we've seen the biggest action in the stocks, and you see gold here, which is selling off. It looks like it's hawkish on the side, or not as dovish as expected. So you're getting dollar strength, selling in T-note and gold, selling in stocks. You can see this now. See how the market initially spiked when they heard that there was a...
But that one's going up, right?
Yeah, that's the dollar index.
Yes. I think they should stop by now because it kept coming down now.
So it's quite interesting to see what happens. So that's obviously the initial stuff. We still got the press conference to come at past. But
wouldn't you sell there? I mean, because it cannot go even higher.
Well, the problem is, normally you can try and fade the moves, but I think if in anything on this, I'd rather go.
I would be very happy with that one. Just sell.
It's not a huge move in the dollar, but stocks now are really dropping. Right here, USA is down over 200 points.
David?
Yeah.
How long would you usually take for it to stabilize?
So,
I don't know if that's a
yeah.
broad question, but
so normally, because there's a second part to come, people will react to what they've heard there, and they panic and trade. After maybe 15-20 minutes, it starts to sort of find a level, and then people are like, okay, we'll see what Powell says. If Powell basically contradicts a little bit what came out in the statement, you can see reversals. If he reiterates it, then you can see another extension on the move. So basically, like I say, it's not as dovish as people hoped, and people were betting on it being dovish going in. So this US 500 still up around where it was about midday, late morning, but you can see everyone was jumping in beforehand, thinking this could be more dovish. I think he said I'm not 100%, but they're pricing now 2 rate hikes next year, the Fed dot plots, where it was 3. So they have brought that down, but obviously with market.
So it will be 7 instead of 8.
Well, yeah, you're not sure, but with the market expecting 1, it's probably not enough to now see the market expecting none, and they might start to think it's not going to be that high.
You might be able to get it.
Yeah. So, but yeah, it's moving stocks. It's vulnerable, and like I say, if they take out those lows, it could be weird.
You don't wait 20 minutes. It's only in the first 5 minutes.
Yeah. The big volatility stocks look like they're scared by this because he's not caved in to what Trump wanted, and he's not going to say if the stocks are dropping, I'm going to cut rates. Yeah, stocks now down 50. 25, 29, remember I was saying was the level? That's the low from last night and the low from back in February, so if we lose that, it could get quite
same as midday.
Yeah.
What's the US 30 like? Is support for that?
23,730. I don't think that's a daily low though. It's about the low of the day. But you can try and trade in around this in the short term, and like you say, you can think this has spiked too far, I'll take a short position, you can try and step in, but you need to be careful because if you do trade, it always have a relatively tight stop loss, so if it goes, it can keep pushing. What could be telling though is the T-note. Remember I said see it as a gauge? The T-note's actually rising, which is it's not in keeping with anything being particularly hawkish. So this could be seen, you might see the market now reinterpret this and think, okay, it's different. You see gold bouncing off the lows.
Yeah, steady, 300 pips.
So yeah, if we see this reverse and the T-note break higher and this break higher and the dollar pull back, then stocks could really rip. So the problem is, from knowing it from a trade point of view, it's not absolutely set in stone, it's your interpretation of it. So you need to
But
think,
if you look at the gold and the index here, they are exactly like midday. You know, like if you
fell back to the levels.
midday.
That's why I said you don't want to use technical analysis on it, but it's good to have some sort of reference point on your chart. Simply the daily highs and daily lows are a very basic way of doing it, but if you can get previous support or resistance, I see gold now is maybe looking to go again. Because we're only 6 minutes after the decision itself.
I absolutely see.
So who would be the losers and the winners in this war?
So initially the people who tried to position ahead of it, you think have probably lost out. The people who were thinking S&P's rallying, I'll buy it up there. This is one of the reasons why I always say it's not great to trade in advance of it. You know, what you really want to do now is to look at it and say to yourself, is 2 hikes next year dovish or hawkish? Is the change in language much? They hiked, which wasn't fully priced in. Is that hawkish? And then try and trade off the back of it. But because these events can be so big, I often think it's better to be a little bit late and right than to be early and wrong. So if you're unsure, you can let the markets digest it, and you can see.
But I think about now, it's about time you can get into the market.
Well, you can certainly. If I was trading now, so say I was thinking to short this, you can use 5-minute candles as your reference point. So you can say, okay, this is pushed higher. If I'm longing here, I want a stop loss below there. Or you could try and say this high is now I want to short off, I want a stop loss. You need to be quite active with your stop losses. Don't jump in with no stop loss because markets can move quickly. Like if you tried to buy this pop higher in stocks, you'd have very quickly lost 30, 37, 40 points, which is a big move in the stock market.
What would you say about
nearly
US
2%. Sorry?
About US 30? I mean, like, let's say if somebody just...
The initial reaction is obviously negative. I don't think it's quite as much as people had hoped for in terms of how they've shifted towards the dovish side. If it loses the lows, then I think it could drop quite quickly. We're down nearly 400 points on the lows now. I'll just keep a close eye on it. Like if you're trading it, you want to be careful with stop loss below because markets can. It's down 400 points, but if power comes out and he carries on in hawkish, this could be down 1,000 points by the end of the day.
So tomorrow morning, if FTSE will look like it's whatever here.
Yeah. So that's a good point actually. We'll just flick across to that. So we'll look at FTSE futures and DAX futures. So the cash market's closed for both of those, but you'll see probably. You can see here the candle's actually frozen, but it's dropped quite a lot. There you go. So the FTSE's down not far off 1% in the last 9 minutes, and this is the US Central Bank.
But it shows you where it's headed.
And I'm sure we'll have similar moves in the DAX. So these are hourly candles. You can see the whole day's trade has just been erased to the downside. And if it keeps going, we could easily be around these levels or even lower by the time we open in the morning. So.
But that's your stop chapter.
Yeah, it's good, but if you're trading, that's one of the reasons why it's good to trade these markets that are still open. Because if you do trade just stuff that shuts at 4:30, you have a big risk. I used to trade oil futures, and one of the guys I traded with used to trade the FTSE when he first got into it. So he had a bit of money saved up and used to just CFD trade the FTSE. He said he had a strategy every morning, he'd just buy it, leave it, and it was a bull market, it was going up nearly every day. And one day, this was 10 years ago probably, and it followed FTSE cash hours, so it traded from 8 in the morning till 4:30. And he made money, and then there was a Fed decision one night. He wasn't aware of what the Fed was. And he bought it, and his trade had gone nicely on side, and it closed at 4:30. He said he'd gone to the beach and forgotten about it. Checked his phone, was like, oh, that's nice. 8 o'clock in the morning, wiped out everything he'd made in 3 months. Because you have that big gap risk if the market closes. If you trade FX or any of these futures, you can have stop losses, and if it goes wrong, you can cut the loss quickly. But the gap risk is the biggest worry.
It happened to me. I went to 900,000, and I was flying, so I forgot the 10 o'clock. And Monday morning, I was minus.
Oh, Friday night, yeah, Friday night. That's the gap risk for FX.
Yeah, and I was flying. I didn't know, but America has different timing.
Yeah, it can get difficult, and we had quite a big move over the weekend when Trump and Xi met at the start of this month to the upside. The market's gapped quite strongly higher, and oil. There was basically strong hints that OPEC were going to cut production, and oil gapped higher by like 4 or 5%. Sunday night actually opens 11 o'clock. And yeah, we had a huge gap to the upside in oil. I mean, gaps can work in your favour, but as a trader, you always want to be in as much control as you can, so it's always better to where the market is open and you can limit your risk. So this isn't looking too good for stocks, but we'll see. I'll just try and get the Fed website up. We might be able to listen to it through here, hopefully.
David?
Yep.
So what's the one at bottom? Which one is it?
It should be. Have you got the? So it's. I think it's. It's might need a different code, but they've got it on the
I use mine. So
yeah.
Thanks, man.
Yeah.
But there's no such. There's no X. X6. There's no.
Wi-Fi is called X. The
X. We tried.
the person is TC129. Is it mainly X? Translate it as XT134.
See if we can get out here. Yeah, here we go. So live streaming the power speech starts in about 15 minutes, but we can have it on in the background and watch the markets. Because sometimes it seems to happen quite a lot in ECB meetings. You get the rate decision at 12:45, press conference follows at 1:30, and you often get one move at 12:45, and then the President Draghi in that case says something different, and it reverses. It should be up here. Yeah, it seems the T-note isn't really confirming the other moves. This is a bit of a odd sign to keep an eye on. You can see stocks obviously taking it negatively, gold and the dollar is rallying. But the move in the dollar is not huge. We're talking 35 pips, euro US dollar. You see what I said earlier about dollar yen can be a bit mixed because it has the dollar aspect and the risk aspect. So the dollar's rising, which is propping it up, but then stocks are falling, which is weighing it down, and it's actually little changed. I don't think dollar yen's great to trade off the back of it. You can see we're just looking to break the lows on the euro US dollar and 25.40 the S&P. So unless we get something pretty dramatic from Powell, this could be. What I sometimes do as well as it progresses is you can use sort of candlestick confirmation. So you have a 5-minute chart and then use 15-minute charts, and then you start looking at that as it goes through. So if you turn it to 15 minutes.
I'm short.
Finished.
30. I'm short.
I've got around 60. Second.
David?
Yeah.
Oh,
that's fine, no problem. Yeah, of course, thanks. Yeah, it's feature account manager, or you drop me an email if you
I was
haven't.
back to action and read it out.
How's that action? Do you want me to get action?
No, it's
okay.
okay.
Cool, cheers.
Actually, would it be possible to have a look inside?
I think they don't really have D30, but D30 is 2 years almost long now. If somebody wants to get long, that would be the best time to get long on the German day.
David, have you got like a long-term view of S&P 500? Or medium?
Yeah, it depends all about this level.
Yeah.
25, 29, I think. If we drop below there, I was talking about earlier, if we drop below there, I think it gets very negative.
Yeah.
Looking forward, it's pretty much in line with the February bottom. If we can bounce from here, then I think we could rally into year end, which was my kind of base case scenario before today. But I say if we do get more downside on this, then it looks quite negative. You can see US 100 as well. What's your view on it?
US 10?
I was looking at 500, probably short.
Yeah, I mean, nearly every way you look at it, it's in a downtrend now. It's below the 200 SMA, below clouds, below EMAs. Keep getting tempted to try and look for a bounce somewhere, but until you really get a nice reversal signal, there's no point trying to.
But you still have got 2 more hours to go.
Of course, yeah. And that can be a third way of looking at it. So you can sometimes get a move here on the Fed decision, a move on Powell, and then a move into the close. By 9 o'clock, you're pretty sure how the stocks are taking.
But judging of this, it was the first 5 minutes. Nothing changed from the last. The first
Nothing huge.
I mean, look at the dollar.
The dollar hasn't locked, but if you look at the S&P now, it's 15 points off the lows, and that's 5 minutes. It doesn't look a lot, but these moves in the stock market are really, really big. 15 points is 0.5% in a few minutes is a big bounce. I saw a list the other day of the Dow Jones Industrial Average, the 10 biggest ever days in terms of points, and I think 8 or 9 of them have come this quarter. That is very, very volatile market at the moment. You're seeing 2%, 3%, 4% days quite regularly. Whereas that's last year, it was. This bounce off the lows would be an average day in 2017. So markets change and you have different volatility.
I know, because they were talking about the technology, but that day when it was down 500, they lost 1 trillion.
Yeah, tech stocks have been some of the most volatile, especially phones. NASDAQ.
How they will recover from 1 trillion?
It's one of those things, isn't it? Because with tech stocks, everyone was like, how are they worth so much? And then all of a sudden they drop massively and then people aren't as keen on them. I think they could recover. If you look at companies like Amazon and the areas they're going into, Apple.
But the brokers always have got this terminology. They say, well, it's correction.
It's a correction, yeah. If you want to buy it, it's a correction. I mean, I think it's different. If you want to invest long term, it's hard to make a case that's brilliant at the minute for US stocks because you've missed a 10-year bull market and you're buying when valuations are quite high. But that's not to say it can't rally again and go higher. The last 6 months in bull markets often accounts for a large portion of the gains in the bull market because you get a sort of blow off top. like we saw 2006, 2007, especially 2000 tech stocks and the dot-com bubble. But I don't know, I think the outlook is getting clouded, but one of the reasons I thought we could bounce from here is there's quite a lot of pessimism around, and often when you get overly one-sided sentiment, you get a snap back to the other side. We saw a good example of that with oil. When oil was 4-year highs 2 months ago, everyone was saying it's going to $100 a barrel. 2.5 months later, it's lost a third of its value, and people are saying it's going to 30. At both extremes, you're probably a little bit too far gone, but it's dangerous trying to pick tops and bottoms, especially in volatile markets like tech stocks or oil, because they could easily go another 10% before turning, even when stuff suggests so. I think oil's oversold at the minute, but I'm not trying to buy it.
But I think the housing market in England is very important.
Yeah, I mean, like almost everything in England, Brexit is so important to it, isn't it? And what happens, the difference between a no-deal Brexit and some sort of deal is, you know, it could be 20% house prices, 25% house prices, and that's massive.
It's been very dull for the last 6 months.
Yeah, I guess it's stopped, especially in London, hasn't it? It rallied very strongly for most of this decade. The question is it sort of pausing, or is it going to turn lower? Well, you could say similar for US stocks, rallied very strongly for 6-7 years. This year, really, I think we were saying earlier, down 2%, down 3%. It's not a terrible year for US stocks yet, but if it does turn lower, then we could get negatives. Yeah, sure.
What years did you trade the oil?
2010 to 2013.
So that was when it was on the computers then?
Yeah, it was on computers. It was from, oil price was roughly between $100 and $125 a barrel when I was trading. So it's just after the financial crisis when it recovered. But it was similar to this, a little bit different, like how you actually traded it. It wasn't so much outright trading, it was what we call spread trading. So you trade one oil contract against another oil contract, which allows you to trade bigger volume because you're trading the relative price.
Could you put your bid and ask in?
Sorry?
Could you put
yeah,
that's what I used to do as well.
Yeah.
But you can't do that now.
You can at some places. My friend who I was speaking to about trading earlier, he still trades. He trades a little bit of oil, but mainly Canadian interest rates. And it's direct market access, you know, like a market ladder.
Oh, right. Yeah.
Bids and offers, and you can queue. But you know, some of the spreads I'll trade would be like 15 cents or 10 cents in a day, so it's not hugely volatile because you're looking at the difference in price between oil in February and March. So if the oil price is down 5%, it might be down 5.1% in February, it will be down 5% in March. So you can, you don't get as huge moves basically, and you can do so. It's like a curve. So you look at what the oil price is expected for the next, 5 years, and then you trade relative parts of the curve. Yeah, I like doing it, to be fair. It's a good job.
So what time are they going to have a conference?
7:30, so in about 5 minutes, I think.
And the TV might just off. It says it's going to be off in 1 minute.
So what's that?
The TV.
Oh, did it? Thanks.
I mean, to be honest, like US stocks are really low. I mean, like if somebody wants to take risk, the risk ratio wise is really good. To be honest, it's 1 to almost 4 in that case.
Well, how do you calculate it as 1 to 4?
If you just get the lows of January from that time.
Well, I mean, here, if you have a stop at 25.25 and you're targeting 29.46 was the all-time high. You've got a very good risk reward on it, but like I said, it's very important I think that these lows hold. Another way of looking at it, if we break below 25.30 and we go to a downside, we could easily do another 8-10% lower, and you'd say your upside risk. So this is why these sort of markets are really nice to trade, and especially around big events, because if you do get something big and lasting on it, today you could get a huge big red candle, or if we can now recover and take out those highs, that's very bullish price action, isn't it? And it's quite nice because you can frame the trade either way. If it breaks to the downside, you probably need, given the volatility, 40, 50 point stop loss, which is wide, but it's totally feasible to target 300, 400 points if it goes in your favour. So we'll see what Powell says, but stocks are looking to bounce. See dollar yen just push to the top side with dollar strength, and then obviously stocks recovering.
Would you say the gold and 500 would be the same?
They're basically if something's hawkish or less dovish, it's negative for both. They're the opposite to the US dollar.
Together.
Yeah, they're the opposite to US dollar. I mean, if you look at this chart, this chart, this chart, this chart, and this chart, or just US 500, US dollar, and gold, similar move. Because you've basically got that less dovish supply, you've got dollar strength, you've got negativity in gold from that, and negativity in stocks. Which is why it's good, I think, to look at several markets, because if you imagined just trading this, you might be thinking, I don't see that hawkish to me, this doesn't make sense. But when you're seeing the other markets support it, the one that's still not really confirming this, though, is the T-note. Because you would expect, if it's hawkish, to be doing something similar to gold. So that is a potential sign of this first move.
So what is the difference between euro and pound?
So it is, both of these have the US dollar
Yes.
as the secondary pair, and then it's obviously just the pound or the euro. So you can see here very similar price action, because the pound euro won't have changed much in the last half hour, but the dollar's appreciated against both of them.
Because that and euro was losing and the pound's going up.
Now the pound's using as well, I think.
This pound.
I might not have it drawn on.
It's not in the top.
Oh, that's the dollar index.
Oh, okay.
So if you get dollar strength, you see pound US dollar fall, euro US dollar fall.
Yeah.
If you get dollar strength the same, you get dollar index rising and dollar yen, because that's the first part of the pair.
Okay.
I'm not sure if this is playing well. Hopefully it's not coming. Just keep an eye out.
It's kind of recovering.
Yeah, you can see stocks are bouncing off here. And like I say, if
So
they now
there's not any new.
if they take out the highs, it's very positive if they can drop like that on this and still see it as a good sign. But the question now, you've got quite nice reference points again, highs and lows, and I wouldn't try and trade it around this level, but probably if we drop either way, I'll be willing to go with that. So I looked along on the upside. You're giving up 35, 40 points because you're not getting in sooner, but you have a lot more conviction in the trade. The same as short here is not great for me because we're only 30 points of pretty key support. So I look to trade it on the breakout if anything. You can see still gold's a bit worrisome maybe. We should get the press conference soon. For the press conference, the first 5 minutes he just reads out the statement, which is already out, so it doesn't really do much. But as he goes on, he gets questions from journalists, and that's normally where they sometimes sort of let slip what they're really thinking rather than like a pre-prepared statement that they've rolled out. There will almost certainly be a question about Trump and if he's putting pressure on him and if that's impacting decision making. You might actually, if anyone checks Twitter, it might be worth watching to see if Trump tweets. see how the squawk is ahead of us, which is why I was going to listen to the squawk.
I'll explain how my colleagues and I are incorporating those cross currents into our judgments about the outlook.
We're not going on that.
Since September, the U.S. economy has continued to perform well, roughly in line with our expectations. The economy has been adding jobs at a pace that will continue bringing the unemployment rate down over time. Wages have moved up to numbers across a wide range of occupations. Inflation has remained low and stable. Recent years have been more severe than expected. Some American families and communities continue to struggle.
Annoying, we can't get it on there.
Despite this robust economic backdrop, our expectation for healthy growth that we have seen develop today signals some softness relative to what we were expecting. Growth in other economies around the world has some level of diversion in 2019, albeit still some. At the same time, financial market volatility has increased over the past couple of months, and overall financial rate has become less supportive. In our view, these developments have not fundamentally altered the outlook. Most FOMC participants have instead modestly lowered their growth and inflation forecasts for next year. The projections of committee participants released today show growth continuing at healthy levels, and employment rate falling a bit further next year, and inflation remaining near 2%. The projections also show a modestly lower path to the federal funds rate, which should support the economy and keep us near our goals. As the economy struggled to recover from the financial crisis and subsequent recessions, the committee held our policy rate near zero for 7 years to give the economy the best chance to recover. And the economy did recover steadily and slowly. 3 years ago, the committee came to the view that the best way to achieve our mandate was to gradually move interest rates back to levels that are more normal in a healthy economy. Today, we raised our target range for the short-term interest rates by another quarter.
I say this isn't really anything yet, because he's just reading out the statement, which is already public. You can see the dollar yen though starting to take off a bit. You see gold on the right hand side. I don't think there's anything he said, it's just.
We always emphasize that our policy decisions are not a preset course and will change if incoming data materially change the outlook. And given recent developments, the statement notes that we will continue to monitor global economic and financial developments and assess their implications for the economic outlook. Now I will provide some additional context and detail, starting with a review of policy over the last year. Last December, the unemployment rate was 4.1%, and inflation had been running just below 2%. FOMC participants and many other forecasters were predicting that growth in 2018 would be strong. This growth was predicted to push the unemployment rate down to near historic lows, and the increasingly tight labor market was expected to help push inflation up to 2%.
Yeah, keep an eye on gold.
Given this outlook, committee members judged that the appropriate way to sustain the expansion of inflation near 2% was to continue gradually withdrawing extraordinary support.
I think gold for the long term will still go up even after this Fed decision and stuff like that again.
I mean, the long-term prospects for gold are good because if things go wrong, people normally like to buy gold. It's a safe haven. So after a long period of pretty good economy globally, you'd expect if it does turn worse, then it will support gold. But I think, in the near term, it's very much going to be driven by what happens with the dollar and how this is perceived. And it's not a huge sell-off, but it's down just over 1% from those highs I think we saw before. It's about 12.58.
Yeah, that's why I just came out last week. I just bought it around 12,000. Yeah, around 12,000. I think it was like about a month ago, something like that.
Yeah, that's it. I was looking for it to break higher for a while. And what we could even get here is if stocks drop hard, people start to panic today, we could see gold get some sort of recovery because people will put money into gold. But stocks seem to be holding up all right, considering. You can see the dollars going again.
I don't know if you remember last time it happened to me as well. I made around before the North Korea and America discussion.
Yeah.
I made a lot of money on US 100 and stuff like that, and I just didn't put any stop loss. And I was minus. Next morning I woke up, was minus around. I bought US stock. I was minus around 5,000 pounds.
Yeah.
And I didn't really put any stop loss, and it got down and down. And I was like, okay, now I'm almost half of my account, so I'm not gonna take it out. So
stop loss is so important. Like, always have a stop loss whenever you can. Get it on here and we'll be back a bit there. You can also start to imagine it as in sort of 30-minute candles, hourly candles. So now we're at 7:37, but if, for instance, we do get back above there, the hourly candle will actually be a very big bullish hammer. So on these events, always use shorter time frames, and then scale up the time frames as time passes, and obviously up until daily at 9 o'clock tonight, and then you can look at what today's trade's done. Nice if we could get this sound working. And there's a Doppler. It's got an echo, I don't think it's going to work.
We know that our policy decisions affect all American families and businesses, and will continue to make our decisions objectively and based solely.
That's the end of the statements. They're going to take questions now, but I don't think there's annoying echo. So this is the part where you might say something which is a bit unexpected, really.
go into education moving forward. As I mentioned, there's significant uncertainty about the path to the ultimate destination and further rate increase.
You can see differences as well if you look at the US 30. US 30 is acting a little bit weaker than the US 100, you can see. See how this market's trading compared to that. And then obviously all the stocks in the US 100 and US 30 are on the US 500. So if you trade in one, it's good to keep an eye on the others.
Took away the lesson that the markets were very sensitive to news about exercising down asset prices. So we thought carefully about this on how to normalize policy that effectively have balance sheet runoff on and use monetary policy, rate policy to adjust the economy. And I think that has been a good decision.
So here is trying to break lower.
What would be the critical point of US 500? You think?
I think, yeah, 25.29, which is basically the low from yesterday and also the low from February. I think if it goes below that, then it could get quite...
Below 20 what? 25?
25.29, so I've got that. I think that's a crucial point. You can see US 30 is broken, it's just hit its lowest level of the day, which could drag it down. We'll find a better way of keeping us in time with this.
Chairman, Steve Leach with CNBC. Tell us how three things affect the outlook for the economy and rates. First is how the market's decline affected the outlook for the economy and for rates. The second is trade tensions and the tariff war, how you factor that into the outlook. And the third is comments by the president urging you not to raise.
So as I mentioned, we monitor a broad range of economic conditions, including financial conditions, and we took on board the tightening of financial conditions, which not any one condition, but broadly speaking, financial conditions have tightened since the September meeting. So we took that on board in our forecast. That's why the forecast for growth and inflation went down a little bit, but remember that's in a context of a more accommodative path. So we also took down our rate forecast. So we definitely did take that into account. And as you can see from the statement language, we acknowledged those risks in the clause about monitoring developments. And,
can you see your tweet? I'm sure Trump will say, I told you so.
I did check, he hadn't said anything yet.
I'm sure he will say, I told you so. Don't touch.
Concern among business people and market people about global growth, and that may be partly about trade tensions, may be partly about a variety of things. If you just mechanically drop into a model of the U.S. economy tariffs, you don't see very large effects. The large effects would have to come from financial market changes or from losses of business confidence. And those are things that are very difficult to model. On your third factor, political considerations have played no role whatsoever in our discussions or decisions about monetary policy. We're always going to be focused on the mission that Congress has given us. We have the tools to carry it about. We have the independence, which we think is essential to be able to do our jobs in a non-political way. And we at the Fed are absolutely committed to that mission, and nothing will deter us from doing what we think is the right thing to do.
You're about to undershoot your inflation target for the seventh straight year. You forecast and say that you're going to undershoot it for the eighth straight year. Should we interpret the dot plot as suggesting that some members of your committee believe that policy should be in a restricted range by the end of next year? If so, can you help us to understand why you will be advocating monetary policy at a time of persistent?
He's done it before like non-farm payrolls, tweeted that morning saying US job numbers are really strong, and the markets will react because he gets them before they lose.
You're right.
He comes up with some excuse like I didn't see the real numbers, I just thought in general the economy was strong.
We're very close to 2%, and we do believe it's a symmetric goal for us. Inflation is symmetric around 2%, and that's how we're going to look at it. We're not trying to be under 2%. We're trying to be symmetrically around 2%. And I don't, I've never said that I feel like we've achieved that goal yet. The only way to achieve inflation symmetrically around 2% is to have inflation symmetrically around 2%. We've been close to that. We haven't gotten there yet, and we have not declared victory. So that remains to be accomplished.
I'm Jean Smiley, Bloomberg News. Just following up on Vinny's question, I guess if you haven't achieved 2% inflation and you don't see an overshoot, which would be sort of implied by a symmetrical target, what's the point of raising rates again at all?
So again, I go back to the health of the economy. You look at 2018, as I mentioned, this is the best year since the financial crisis. You have growth well above trend. You've got unemployment dropping. You've got inflation moving up to 2%. And we also have a positive forecast, as I mentioned. And in that context, we think this move was appropriate for what is a very healthy economy. Policy at this point does not need to be accommodated. It can move to neutral. So it's appropriate that it be neutral. We're now at the bottom end of range of estimates of neutral. So that's the basis of how we're treating this. I also think we took on board, the risks to that. And,
He's just holding the support still. Bouncing from that.
But nothing happens to the dollar.
It's edging higher, but yeah, nothing much. They're like the main moves on that initially.
Can you talk a little bit about what you expect to get from that panel, and will the dot plot be involved in that at all? How do you think the dot plot is working? Are we dealing with it the way that you want to be handling the dot plot, or is it that you might tweak a bit?
So this review, what it really is, it's coming at a time when the economy is strong, and it's a good time to take a step back and ask whether our strategy and our tools and our communications around monetary policy are doing the job.
Sure, thank you. Cheers. Yeah,
open ourselves up and have a discussion with many outside groups, all different parts of the economy, including an academic conference in June in Chicago. And again, the idea is to listen to new ideas, better ideas, old ideas, many of them have been around, and try to assess whether there are better ways we can do things. One of the overarching facts is that rates have been really coming down overall for more than 3 decades now. We may be in a world where interest rates are just lower for the time being, and therefore we'll have less policy space to react to economic downturns. And we want to be evaluating ideas for, again, for better achieving the goals that Congress has given us. We're not looking at law changes at all. We're not looking at changing the inflation target, for example. We are looking for better ways to achieve the inflation goal, for example, on a spectrum basis. So that's the sense of it. So as I mentioned, I want to talk about the dot plot. I think the dot plot generally does provide useful information about the reaction function of committee participants, sometimes more useful than others, I'll admit. But in general, I think people sort of have it figured out and understand what it is and what it isn't, but that doesn't mean we
still just toying with those levels in stocks, isn't it? I think 6,400 is the one here, which is a bit of a level.
Each of us writes down, we always update it as as data come in and as we update our outputs.
Michael McKee from Bloomberg Radio and Television. The balance sheet reduction, how much additional tightening do you think has come from that? And we know from the markets that the cost of credit rising, commercial paper, no rates, debt spread widening. Do you see any concerns about the availability or the price of credit that could slow the markets? And if in 2019 we see the economy start to slow, would you, if you don't adjust the balance sheet, be risking too much tightening?
So we do watch all of that, but the amount of runoff that we've had so far is pretty small. And if you just run the quantitative easing models in reverse, you would get a pretty small adjustment in economic growth.
Looking to break.
So we don't think, things that are happening in the short run, sort of the short end, are driven by many other factors other than
what's happening on the Treasury Market?
very large bill supply.
So I don't think he's said anything, but it's a continuation of that first move.
Has raised short-term borrowing costs. So, we're alert to these issues and watching them carefully, but we don't see.
But what is that 25, 29?
It's just a high from yesterday that I drew earlier. The low from yesterday, sorry, and from back in February. It coincided with it.
We've seen enormous volatility.
You can see.
Markets recently, even though the president said raised interest rates, it's well documented. The National Association of Realtors chief economist says that it's starting to affect first-time home buyers with the mortgage rates going up. When do you think these policies need to come in next year? Do we keep this, as you say, gradual? And then, in addition, what data are you specifically looking at for you that shows when the Federal Reserve starts to become that headwind in the economy with the rates?
We're watching. We have a strong forecast generally for next year. That forecast involves growth at between 2 and 2.5%. It involves growth at a strong enough level to continue driving unemployment down and inflation near 2%. So that's a pretty positive forecast. So to make further moves, I'll be looking for data that suggests that that's in fact the path that we're on. As I mentioned.
So from these lows here, I think if we take that out, it changes it quite a lot. Have to see if it drops below it and also where it closes tonight. If we get a daily close below it to confirm that. But.
Telling you about the outlook, updating your estimates of what neutral might be, and what the natural rate of unemployment might be of the state of the economy. So, and letting that lead you to adjust your outlook and therefore your appropriate path for policy. So that's what we mean when we say we're data dependent. Of course, we're always data dependent, but in this particular meaning in this context.
I wanted to ask, first of all, whether you're worried that President Trump's tweeting and statements might interfere with your ability to communicate with markets and why you're doing what you're doing. And then also I was wondering if you could comment on Governor Brainerd gave a speech recently where she laid out the case for the countercyclical capital buffer being activated. Do you disagree with her analysis? Is that something that eventually we'll look at doing?
I'm not worried because on the first question, because I know, and everyone who works at the Fed knows that we're going to do our jobs the way we've always done it, and that involves, getting the best thinking together, diverse perspectives. Every business, every FOMC cycle, we talk to hundreds of people in all different parts of society, not just business people, market people from human development organizations. We get survey data from thousands of people. And so we really do have a pretty broad exposure to what's going on in all different parts of the country. And we're going to take all of that information.
Yeah, it's looking like a continuation of the same moves really, like more weakness in stocks here. 6,400 could be key for that. 94.50, 96.50, sorry. It's not a massive move in the dollar, but the stocks is quite a big one, especially as you consider it was 25.90 just after its release.
The gold is still.
Gold's looking to go again, yeah.
And so that's a tool I'm absolutely willing to use and happy to use at such time as that test is met. We meet and discuss that and evaluate it on roughly an annual basis. We haven't done it since early this year. I think we'll be doing it early next year and we'll be reaching that judgment. Then I will tell you, I recently gave a speech saying that I believe that financial stability vulnerabilities were roughly at a moderate level. So
The Dow, I think it hit 24,000 earlier, it's down over 500 points. So it's clearly not liking it.
Would Dow affect 500? I mean,
yeah, it will. So all the companies in the Dow's US 30 Dow Jones Industrial Average, all those 30 companies are in the S&P 500. But there's obviously some companies in the S&P 500 that aren't in the Dow. So there's
sometimes I see the SPGs going up.
Yeah, it can. I think Johnson & Johnson's in the Dow, isn't it? And that's in the S&P 500. But because there's only 30 companies, it's more important for the Dow. But you can see we're selling off now quite hard.
Individual forecasts are not something that the committee votes on. They're out in the future. We vote on the rate increase and we write down our own personal paths. So people have
when that level broke at 25, 29, where would you have jumped in?
As soon as possible after it, yeah, and have a stop loss of decent level.
So you'd leave it, what, let's say 5 ticks and then you jump in?
Yeah, you don't want to be too precise, you don't want to be, half a tick, 2-3 ticks.
And then you jump
yeah. If you wait for 10 or 15, you normally miss quite a lot of
it. Right, yeah, because then you bounce.
And then you can try and have a stop loss above the relevant candle. I mean, it's a very fast moving market, so normally on a breakout you don't need to be as wide, but on this you probably need give it a little bit more.
Yeah, but the way that's, the US S&Ps.
Yeah, it's accelerated.
But then the FTSE moves like that anyway.
Yeah.
And throughout the day, the FTSE futures will have movements like this.
It can do. This is a big move, though. It's pretty much 3% now from the high in an hour, which is a pretty large move by most measures.
Yeah, for the S&Ps, but I mean, FTSE futures, you'd guess, you could be trading 30, next thing you know, could be trading 40, 45 within 5 minutes.
But that's only 0.2% sort of move, isn't it?
Oh, right,
So, a point in this is bigger than a point in FTSE, because you call it 2530, it's really 2,530. The FTSE's 6,600, is it? Something like that? I can't remember off the top of my head.
What you're picking up now, I think, is there's, a mood of concern, or it's a mood of angst about growth going forward. If I could just capture it in one thought. There are many reasons that are given for that, but generally speaking, it's the concern about is growth going to be as strong as it was? Why not? What might
but now, particularly for stocks as well, you start to see people trading into the close off the back of this, but also for other reasons, trying to position. So that's why it's important to watch it into 9 o'clock really on stocks, because you could get a real bullish recovery into the close, and this looks like a false break lower, or you could get a flush where people are like, I want to go. So.
The outcomes that forecast, but also in a lower rate to provide some accommodation.
But it's looking like a continuation of the first move, really. A bit like I was saying to you, this is why if you see it drop 30 points, I wouldn't look to stand in the way of it, because if it's a big enough move off this, it can go 70, 80. This could easily go another 100 points in the next few days quite quickly if it gets ugly. You see the US 100s took out 6,400.
The financial conditions, broadly speaking, we don't look at any one market. We look at a really big range of financial conditions. And what matters for the broader economy is material changes in a broad range of financial conditions that are sustained for a period of time.
Is anyone else got
volatility, speaking of the absolute, volatility doesn't probably leave a mark. on the economy. So we look for that. And what we've seen here is a tightening. There's been a tightening since this, right around after a week or so of the September meeting. And that we try to factor that into our models of the economy, the results that come out of those models. That's how we think about it. So we do, we follow markets really carefully, but from a macroeconomic standpoint, no one market is a single dominant indicator.
Just hold it I do long term. Okay. These kind of decisions, I get in early and I just leave it till it hits my profit goal. Because my stop loss is not long, like 140 something.
When you think of other measures like setting a target for economic growth and relying more on that.
Less risk.
Well, I think
we look at probably trade like
core PCE.
Yeah, good. It's more of option.
It has
but
what's
those few
happening
big
over
ones, I think.
really 50 years.
Yeah, I just came out.
Inflation has become much less reactive to changes in growth.
Did you start like?
There was a time when inflation
So that when it was about over 100 or something.
changes growth,
Puts on
changes
the
in
profit.
unemployment, and that time is behind us, and that is
Oh,
often
well,
related to the successes
That's
of
right.
anchoring inflation expectations, so that people believe that inflation will come back to the target or around the target, so it doesn't go down as much. Inflation doesn't go down as much, and the downturn doesn't go up as much when when the economy is strong. It's really true though.
So what's your target should say for
not react
the
a lot
USD?
on a road of from
USD is
10%
around 24,
unemployment to
100.
now 3.7%.
No, like even above that. So around 20.
In terms of just targeting growth,
24,
I actually think our dual mandate.
Oh, so you
Above
use
that,
long.
if you go Fibonacci, before it hits, before it goes to 38 Fibonacci, I just get out of the market. Because that's one of the places
Yeah,
that just
yeah,
concentrate
30,
and just,
30 or 50.
I just can't be bothered to just.
Don't you have those three strong? 1, 2, 3. So what else?
I mean, to be honest, like the market is best.
But
Which one do you trade?
when I said pound dollar,
Pound dollar.
sorry, but I do it by minute.
But like you're seeing here, he has 500 this way. It's
Yeah, I mean,
important
this
to
is
draw your
very
daily
strong
times.
one. Wouldn't you just go?
Yeah.
I mean, blindly. This
is the clearest move, and once it took out 25,
Exactly,
30, that was another entry.
But not in this condition we are now. I mean, it was different.
It's going to drop below 2,500, it looks like.
Relate that to the state of the economy, expectations for policy, global developments. I think it'll be.
I would have gone if it wasn't for this announcement and I see those three. It will
Yeah, well,
definitely
it's always worthwhile listening to what's happening,
Yeah.
but you can trade it from a price action perspective as
Yeah,
well.
but would you go because of these three bars you have? That the next one will be definitely.
If I was looking, the thing is this bar's still not closed yet, but I think a break of 25.30.
You still wait for the fourth bar?
No, I think a break below 25.30 would have been quite a good opportunity. The difficulty is you need a fairly wide stop loss because where it's come from. But you see,
We'll move to a more.
I just put it full screen.
Have the ability to move at 8 different means, not 8 times.
We have the sell-off sort of consolidation. Once we broke here, now in 25.30, if we drop below there, you could go for a stop above this candle. Entry down here, possibly. I mean, it's a wide stop, don't get me wrong, it's maybe a little bit smaller size than normal, but you're already, call that 60 odd, you're already about 1-to-1 on side, and so shaded from the long-term chart, there is scope here for 100, 200 points of downside.
Yes, I think that's probably pretty straightforward.
Because what you start to do now, I was saying use longer time frames, so look at it now.
Speeches in press conferences and such.
If you look at it on a H4, I mean that looks pretty ugly. And today is very negative on a daily candle because we took out yesterday's high and we've taken out the low, and it looks like at the minute we're right on the low. So.
What was today's high?
It was just after it came out, wasn't it? If you use this tool here and hover over it,
Now they're all at 3, and they just continue to gradually move up. Not perfectly.
25.88.
88. So it's dropped already 88 points.
Yeah, well, it's 24.90 now. It's 95 points, close to 100. And it's an hour and 5 minutes, so this is why you can get real big moves off the back of this.
And that would be a welcome development. Wage increases do not need to be inflationary. There's plenty of evidence of situations, for example, in the very tight labor market of the late 90s.
But you see how we had the initial move, then it paused, basically to see if Powell's going to roll it back, if he's going to contradict what people think. And it looks like he's not. He's carrying on with it. So
I would be happy just with the first one. It came down, that's it.
Facebook.
Yeah.
Yeah, that's a huge move.
Yeah, I would be out right now. I mean, even for pound dollar. The first initial one.
It's always hard, especially if you're shorting markets,
Don't
because
be greedy. I mean, once you get that one.
markets go down a lot quicker than they go up in single moves. The biggest moves in history are normally crashes rather than rallies like in a day. But you do also get quite big rallies in downtrends. A lot of the biggest rallies come after big sell-offs.
I mean, what does it tell you? I mean, we don't want to look tomorrow at the back one, but at the moment as it is. What would you
I mean, it's very negative. Like I said, looking at the long-term chart below 25.30, there's very little going back a couple of years, and we've had that big, I said, range. 400 points. We could, from a pure technical analysis point of view, you could do another 400 points to the downside. Most trend tools and things like that are pointing lower, but you can see there, even it's just bounced 10 points off the low, it's very volatile.
But just an hour left for the finish time.
Yeah,
so wouldn't that affect it as well? Because people just want to finish it and go.
But definitely, if it closes down here or lower, it's even more negative. If we see it bounce into the close, and it can get back up to 25.50, say, then maybe it's starting to be a bit more
But psychologically, not most people just give up because it's going down. Either they could stop.
I don't know. So you can tell now there's a bit of a reaction happening.
That's prudential standards, particularly for those banks. And I'm thinking of the stress capital buffer, as well as the most recent proposal on banks valued at 100 to 250 billion. GSIBs and the largest banks seem to be sort of left out of a lot of these proposals, and I'm wondering if that is meant to send a message that the Fed does not really intend to change its regulatory structure for the largest banks going forward, or if you'll get to that.
You see what we're getting here in the T-Note's quite interesting. When the stocks drop, you often see the T-Note rise. It seems to say favourable play. So even though it wasn't really, if everything else is really suggesting it was kind of a little bit hawkish, but the T-Note's still showing lower rates because of the drop we've seen in stocks.
So what is the rate now after tonight?
It's quite hard to calculate. I can't do it off the top of my head. It would be. You'll see it often quite in financial media, the 10-year yield. They talk about that.
No, after he just changed it. Right?
Oh, so it's 2.25 to 2.5. It's a range, they say. It was 2 to 2.25. It's now 2.25 to 2.5. So it can move around within that, but they control it if it gets to the outside.
I know that the larger institutions tend to be the ones who care about the local rule. That's something we're working on.
But as the press conference goes on, it's less likely he says anything big. Normally, the statement, the first 10 minutes, you don't get much because it's just been reading it. And then the first 3 or 4 questions normally be interesting. How you feel about Trump?
Exactly what he's going to say.
Now they're asking.
He's talking about politics.
Yeah, that's not the bulk of the rule now when they have earnings for banks, which could impact banking stocks a bit, but he'll probably give a fairly general answer.
Are they expecting him to say something that will affect the market?
Maybe that's what people are asking him, but like I say, if he does, it's normally one of the first things he says.
I know you look at many different financial indicators, but let me focus your attention briefly on bond yields. The 10-year yield has gone down pretty steeply, roughly 50 basis points, I think, in recent weeks. wonder what you make of it. Is it a worrisome sign for you in terms of the outlook for growth, for inflation? On the other hand, could it be a positive in terms of presumably bringing down mortgage rates and helping the housing sector?
Again, we do focus on a broad range of financial indicators, and we don't obsess about any particular one. You know, we look at a whole range of them, and we ask ourselves what's really going on in the broad picture out there. You know, if you ask what's going on with the longer maturity Treasury market has come in some. That's consistent with you know, a risk-off feeling in the stock market as well. And you know, we don't know whether that'll persist. Really, the longer Treasury has moved in a range above 3%, down 3% as the risk sentiment has changed. You know, I think if rates were to stay low for a longer period of time, that could be thought of as a signal of expectations of lower growth. But you know, we don't know that that'll happen. As I mentioned, our forecast for next year is indicated with those other forecasts is that we'll still have solid growth next year, declining unemployment and a healthy economy.
Hi, Chairman. Courtney Brown from Axios. I'm wondering if you can clear up what's become a little bit of a debate in the financial community. You said in October in an interview with PBS that interest rates were a long way from neutral. A month later, you said interest rates were just below neutral, and I think a lot of people interpreted that as a shift in tone from you. Were they right to interpret that way?
Okay. Yes.
Where we are right now, the lower end of the range, lies effectively at the bottom end of that range. Other implications for that, as I mentioned, going forward, there's real uncertainty about the path, the pace rather, and the destination for the rate increase. And we're going to be letting incoming data inform our thinking about the appropriate path.
Chairman Powell, you talked about monitoring global developments. I was wondering, you touched on trade, the trade dispute with China. Could you elaborate on what economic developments you're referring to, whether Brexit is one of those, what else?
More broadly, I'm referring to global growth. So
it's a bit of a pullback, seeing the dollar.
2017 was a year
still quite far down, but
upside surprises in global growth. It was a year of synchronized global growth, and people raised their
stocks as well, just bouncing off those lows.
2017, and in some sense, expect that to continue into 2018. What has happened instead has been a modest retracing of that. So you have still healthy levels of growth in the aggregate around the world, but close to the potential growth rate of the global economy. But you no longer have the really strong levels of growth you had in 2017. So that is one. That's I think the key factor. We also monitor event risks like Brexit, like like the negotiations between Italy and the EU over their budget. And as far as those are concerned, we monitor them very carefully. And I'll mention Brexit. Our financial institutions have had a long time now to get ready for a full range of possible exits from the EU by the UK. And they've had supervisory involvement from U.S. supervisors, from UK supervisors, from EU supervisors. We think they are fully prepared for the full range of outcomes that may come out of that. I'm very happy to see.
So what do you think of US 30 compared to all?
So I think for US 30, this was the level 23,110, which it still hasn't broken.
It's something we're watching carefully. Honestly, it shouldn't have major implications for the United States, but there's a lot of uncertainty because it's not something that's happening. So we'll be watching it carefully. Thanks very much.
That might be the end of it. Yeah, you see from this low here, 23.91. Yeah, absolutely. So nothing major really from the press conference, but overall it seems to have been quite negative for stocks. Yeah, 23.90, something like that. We're back in this sort of region, aren't we? I think if we do drop below there, see how it trades the next 45 minutes. But if we do drop below, then we're looking pretty negative. So it's nice when you analyse charts, look on longer term time frames like daily, and then you can cut down to hourly or M15 or whatever. Whatever you're looking at in the shorter term. But today's close will be key. If we get below and stay below 25.30, that's confirmed break for the S&P. If we close back around 25.30, it's still a negative day, but that has at least closed off the lows. 23.91 and I think 6.310 was the one for this. But it's quite interesting and quite unusual, to be fair, that you get US 500 taking out the early lows, but these two haven't. But yeah, next 40 minutes or so probably determine how we trade for the rest of the week, I think. Going into that and into the real short Christmas period, I was talking about the Santa rally, but it could be a bit, could not come this year, just looking like this. Yeah, does anyone have any more questions?
Are you talking about recession?
Yeah, there's talk of recession. I think it's still a little bit premature for the US. They're still growing quite quickly. But they are slowing down, it looks like. But they've had very good growth. I think earlier this year it was 4% their GDP figures, which is very high by US standards historically.
Why are they talking? Why do you think there's going to be a recession?
I don't think there's any real signs that there is a recession apart from, like I said, the surprise index. The data has got a little bit softer. I think the main reason people think there'll be a recession is because there's been so long without one. And normally, historically over the last 100 years, you've had a recession every 5-6 years, something like that. 2008 was actually quite a long period. It was about 7-8 years from the past recession. And the problem is, the longer it is till the next recession, the worse a recession often is, which is why people are concerned about it. It's a little bit like a market. If it keeps pulling back a little bit all the time, and then it recovers and goes higher, that's quite healthy. If it carries on not pulling back for ages, then absolutely crashes really hard. No one really likes that. You'd rather slow, steady, keep growing. So I think that's one of the things. There's nothing really to suggest that there should be a US recession anytime soon. Employment's still very strong. GDP growth's good. Indicators like, have you heard of like ISM manufacturing, ISM services?
Yeah, but that little hiccup like that day, on TV, all these analysts say yes, it is on the way down.
Yeah, I mean, people say that. People talk about the yield curve and the yield curve inverting, and when the yield curve inverts, that's predictive of a recession, which it normally is, but often the yield curve's inverted and it's still been 18 months, even 36 months till a recession. I mean, we will have a recession, and it's likely there's going to be one in the next few years, but at this point in time, I don't think there's anything really suggesting that. I think possibly from the US, they're looking elsewhere, and they're thinking China's growth slowing, the stocks in the bear market. Europe's had a pretty poor year in terms of growth, and normally, because we're so interconnected with trade, when other big economies start faltering, it does weigh on the US, because obviously you don't sell the products. And also on that front, the tariffs that Trump's bringing in, and these trade tensions, which are bad for everyone really. It's probably worse for China than it is for the US, but it's still bad for the US.
But Chinese they're going to add for their goods the 25% possible to the customer of the US.
Oh, they say that?
Yeah.
I mean, it's general economic
causing
theory.
inflation in your own country.
Yeah, general economic theory is always better without tariffs. Frictionless trade seems to suit everyone because you can go to the cheapest producer.
That's why the people are buying in bulks, because they think once the new one comes, it will be plus 25.
Yeah, that would be a lot. Yeah. But I don't think there's anything immediately warning of recession, but it's just a combination of those factors. unless anyone has any more questions, I think we could probably call it a day there. If I can. Thank you. No problem. I'm not sure how to end this screen.
Yeah, I mean, just on the floor. Go ahead.
You don't really trade based on risk management, you just see the opportunity to buy something.
See the opportunity.
No, I can't get the mouse on.
I'm using like a Fibonacci.
You see, that's moving here, but it won't leave the screen. Oh, there you go.